Hello students, my name is Ash Nandra Jog and today we'll be looking at exercise E2-15, page 45 from the workbook. And let's see the question first. So the question says that journalize the following May 2020 transactions on the 9th page of the journal, then post to the ledger accounts. Use the dates to identify the transactions. So they've given us these transactions, which we will be recording. You can write down these transactions on your journal page given on page 45 in your workbook. I would be using an Excel sheet to write these. So let's look at a journal, how it looks like. So something like that, where you have a date, then you have the particulars, meaning the account name. Then there is a post reference, which we won't use for, which we might use for this question. And then we have debit and credit. Okay, so let's look at the first transaction. On May 2nd, Florence Yarrow opened a strategic consulting firm by investing $39,200 cash and office furniture valued at $16,200. So let's analyze this statement. So Florence Yarrow is opening a new consulting firm. So it's a brand new firm. And she's investing cash of $39,200. And she's also investing into an office furniture whose value is $16,200. So both these items would become assets of the company. And we would have to make debit entries for that. And we would have to make a corresponding credit entry, which will go as a capital for Florence Yarrow, who's the owner. Okay, so how would we record this transaction? Okay, so let's put the date first. Let's write it here, May 2nd, and we would write cash. So we received cash, and the amount is $39,200. Okay, and then we would put office furniture, which is for $16,200. Now both these are credited to the capital of the owner. So we'll say Florence Yarrow capital, and it'll be total of these two. So we can say the total of these two would be $55,400, and we can write a description saying received investment from owner. Okay, so that's how we journalize the first transaction. Let's look at what's the second transaction. It says paid cash for May's rent of $2,500. Okay, so we are paying the rent. Now rent is an expense. So an expense is debited. Remember, we always have to write the debit entries first and then the credit entries. And the total of all the debits have to be equal to total of all the credits. So we have if we are paying cash, that means our cash is going down, which means that needs to be credited. And the rent expense is going up. So we have to claim the rent expense and pay it with cash. So we would say May the 2nd, we have the rent expense, and that is for $2,500. And then we have the cash which is being credited for $2,500. And we can say paid monthly rent. So that's how we record the second transaction. Let's look at the third transaction. It says May 2nd, purchased office supplies on account for $1,800. So on account means we did not pay cash for those supplies. We bought them on credit from our suppliers. So we eventually have to pay them. So that means that will be accounts payable. So office supplies is an asset which will increase because our office supplies are increasing by that amount, and accounts payable is a liability which will also be increased by $1,800. So to record these two transactions, we would first write the debit entry. So we're going to say May the 2nd, and it'll be office supplies, which is an asset, and it'll go up by $1,800 debited, and we would credit the accounts payable, and that will be for $1,800. Okay. All right. Next, on May 15th, we paid employee salary of $4,000 by cash. Now, salaries is again an expense, so we would claim the debit, which is salaries expense first, and then we would credit the cash, or meaning reducing the cash. So, May 15th, we have salaries expense, and we would say the salary expense is $4,000, and we paid it with cash, so cash goes down by $4,000, meaning cash is credited by $4,000, and we can write a description: paid salary expense. And here we could have written the description is purchased supplies on account. All right. What's the next transaction? So May the 17th, paid $1,200 off the account payable from May 2nd. So remember, on May 2nd, we bought office supplies on account for $1,800. So now on the 17th, we are paying $1,200 out of that. So what do you think would happen? Obviously, the accounts payable is now reducing from $1,800 by an amount of $1,200, meaning now it'll go down to $600 remaining. So we have to, meaning reduce the accounts payable by $1,200. And obviously, if we are paying the accounts payable, how are we paying it? We are paying it with cash. So our cash is going down, and accounts payable is also going down, which is the liability. So liability goes down by debiting. So that's why we will debit the accounts payable, and we will credit the cash for this transaction. Okay, so May 17th, we would say accounts payable, and the amount is $1,200. So we're not paying the full amount, we are paying just $1,200 out of that, and that will be through cash. So cash is being credited. Okay. Then May 19th, it says performed consulting service on account for $69,000. So now this consulting company has done a service, which means it's earned some revenue. And it is not received the money yet, because it says it's on account, which means we're going to get the money from our customer eventually. So when we say on account, it would mean account receivable, because that's the money which is going to come from our customers. So it's a receivable. So accounts receivable, remember, is an asset. So that would be debited because it is increasing, and asset increases with debits. So we would say accounts receivable is being debited, and consulting service is a revenue. So that will be recorded as a consulting revenue, and revenue is part of equity or income statement, and revenue increases with credit. So now we can record it in our workbook or in our journal, sorry, and we would say on May the 19th, let's maybe leave a space, May the 19th, we have accounts receivable, which is 69,000. So now we are recording that we are going to get $69,000 from our customer. And why? Because we have earned consulting revenue for 69,000. Okay, so we just saw how we have recorded the May 19th transaction, performed consulting service on account for 69,000. So what we did is we debited the accounts receivable for 69,000 and we credited the consulting revenue account, which is the revenue earned for 69,000. We can write a description: performed service on account. Okay. Now let's read the next transaction. It says, on May 30th, withdrew 8,000 cash for personal use. So in this situation, the owner has withdrawn $8,000 of cash from the business for their personal use. So how this is recorded is, obviously the cash is going down, so cash will be credited, but what we will debit is going to be the withdrawal. So there is a withdrawal account, which is a contra equity account. So that account increases with debits, and you will learn later as the course progresses how these temporary accounts are closed at the end of the period or end of the year. So we will record it in our journal as May 30th. We will say Florence Yarrow withdrawals. And withdrawals are increasing by debits. So $8,000 is a debit and cash is being credited for $8,000. Okay, so we can write a description for that as withdrawal by owner. Okay, so we have what we've recorded so far is the we've recorded the journal entries. Now we have to learn how to post them into the ledger. Okay, now that we have recorded the transactions in the journal, we would learn how to post them into the ledger. So before we do that, let's look at an exhibit to understand this better. So the question arises, why do we even have to put it at different places, right? I mean, we already posted it in the journal. Why are we putting it in the ledgers and all these kind of things? So let me explain. Think of the journal as a notebook. So in a notebook, you are recording things as they happen, but now you also have to put it in the right places. Or maybe another analogy I can use is, think of working in a library. Let's say that you have a lineup of people who want to return their books. If you took the book and now you were trying to put it into the respective aisles or where the books are supposed to be stored, you won't make those people wait in the line, right? You would, then it'll take a long time if you're going to run to each aisle to put the book every time it's returned. So what you do is you take the books and you store them with you and you record in which aisle and at what place it's supposed to go. But eventually someone is going to take that list and then take those books and put them in the right places. So that's the similar process which works in accounting as well. So you record the transactions in the journal as they happen, and then when time comes to post, we start posting them into the respective ledgers. So this exhibit shows us something like that. So here we have some transactions in a journal where there's cash debited of 250,000. This was an investment into the capital for 250,000 credit. Now we have to post these transactions into the ledgers. So the first step is to transfer the date of the transaction from the ledger, from the journal to the ledger. So we go to the ledger, we find the cash ledger, and then we post the date, April 2nd. That's the date. That's the first step. Second step, is transfer the page number from the journal to the journal reference column on the ledger. So here J1 is page number 1 from the journal. Okay, so that's what J1 signifies, journal page 1. Okay, then the third step is post the figure, the debit figure, because this is the debit into the cash, so we would post the debit. So debit goes to debit. Okay, so whatever, if it was credit, we would go credit, but right in this situation, it's a debit, so we'll go 250,000 debit. Okay, and then we would also record the balance. So there was zero balance before that, so now we have 250,000 of debit balance. And then we go to step 4, and now we go back to our journal and we write down the post reference, which is the account number in the posting reference column of the journal once the figure has been posted to the ledger. So once we write it back into our journal, we know that now this has been posted into the ledger. And that will be easy to track. If somebody is looking at the ledger, they can see, okay, so this transaction comes from the journal, from page 1. And if it's somebody looking in the journal, they would know that this transaction has already been posted in the ledger. So that's how the process works. And we can repeat the process for other accounts as well. Okay. So back to our journal. We are seeing in our journal, we have these accounts like cash is an account, office furniture is an account, capital is an account, rent expense is an account. So again, cash is being repeated. So for each of these accounts, we would have a specific space in the ledger identified by an account number. So you can write down these entries on your workbook, starting from page 46 in the workbook and up to page 47 in the workbook. I'm going to use an Excel sheet to write down those entries. So here is the ledger account. So what we see is there is a special space for putting cash entries, and we have the account number 1100 for that. We have accounts receivable, account number 1300, office supplies as 1500, office furniture as 1800, accounts payable 2100, so on and so forth. So these are the accounts in which we have to post the respective entries. So let's go to the first journal entry and see what needs to be posted. So we have cash of 39,200 debit. So we go to our ledger and we would, okay, first the date is May 2nd. So we go to the ledger, we say May 2nd. Okay, and that's the date. The second step, as we know, is to post the entry, which is the journal. What page from the journal are we getting it from? So in our question is from page 9, general journal, page 9. So we will write down something like, we would say GJ, or we will say J9. So J9. Okay. And the amount was 39,200. Okay. So because there was no previous balance, now we have a debit balance. Oh, we have to write down just DR. Get rid of this. DR. Okay, wonder why it's doing this. And the balance is 39,200. Okay. All right, so that takes care of the first transaction, but now we have to go back to the journal and write down which account number has it been posted to. So our cash account is account number 1100. So we go to our general journal and we write down 1100 in the posting reference. Next account we have is office furniture, which is 16,200. So we go and see which account is office furniture. There we go. That's office furniture, account number 1800. And we record the date May 2nd. And we would say it's from J9, page journal 9. And the amount is 16,200 debit. So now we have a debit balance. Debit balance, again, this is acting a little crazy. Debit balance for 16,200. Okay, so we go back to the journal and we write down the account number for the office furniture is 1800. Now the third entry is credit of 55,400 into Florence Yarrow Capital. Let's see if there is account for that. So there you go. This is Florence Yarrow withdrawal. This is Florence Yarrow Capital, account number 3100. Okay, so again, May 2nd and J9 coming from journal page 9, credit of 55,400. Now, what would be the entry here? Credit. Okay, not debit anymore. Now it's credit. So 55,400. All right. So now we go back to the journal and we write down which account this is being posted to. So this one is 3,100. So that takes care of all these three accounts have been posted. Now let's continue. So May 2nd, we have now entry for the rent expense. So we would find the rent expense right here. We write down May 2nd and it's coming from J9 and the amount is 5,500. And now we should have a debit balance. I have to figure out a way to get. Okay, so that amount is 5,500. So that we can go back to the here and we can say this went to account number 5,500. Oh, so the amount for the rent expense was 2,500. I'm sorry, so let's correct it. It should be 2,500. The account number is 5,500. My bad. All right, so there you go. So this shouldn't be a comma here. Just read it like 5,500. Let me just fix it. Format cells. There should be, it's a number and 0 decimal places. And let's write it as, it should be a general. Let's see if that works. Yeah. So now we have account number as 5,500. Okay. So what about cash? So there was a cash credit entry for $2,500. So we have to make that entry in our ledger. So we go to our cash account and we put the date May 2nd, J9, $2,500 credit. Okay. Now, what would be the balance? Would it be a debit or a credit? It will be a debit, and the reason is because you had a debit balance of 39,200. Now you've reduced it by 2,500, but you still have a debit balance. So remember this. So now your balance would be 39,200 minus $2,500. So now your running balance is 36,700. This is the running balance. Okay. All right. So the cash has been posted and the account number is 1,100. All right. Now we have to record office supplies. Office supplies, May 2nd. It is from J9. It's an asset, and as our journal shows us, the amount is 1,800. So we would say 1,800 of debit. Now we have debit balance. $1,800. Okay, and we can go back to the journal. We can say this has been posted to account number 1,500. Now we have accounts payable, which is the credit entry. So we go and find accounts payable. There you go, that's accounts payable, May 2nd, and J9, and The amount is 2100 and it's a credit, so the balance is credit of 2100. Okay, and we can go back to the journal and we can say this has been posted to account number 2100. Okay, then May 15th we have salaries expense of $4,000. So let's find out salaries expense. Salaries expense. So May 15th, and it's coming from journal page 9. It's a debit of $4,000. So balance would be debit of 4,000. Okay, I don't know why this changed to. Okay, so now we have a debit balance in the salary expense. We just recorded it. We go back to the journal and we say our salary expense was recorded into the ledger in account number 5600. Now the cash is $4,000 credited. So we go back to our cash ledger. And this is May 15th, coming from journal page 9, and the amount is 1100, no, 4,000. So $4,000 of credit. And now we still have a debit balance because we still have 36,700 in debit. So, but it is going down. Now our balance is 32,700. So we go back to our journal and we would post the account number for cash, which is 1100. Okay, now we have May 17th, accounts payable for 1200 paid with cash. So that we have to post. So accounts payable is account number 2100 and the date is May 17th, May 17th, and the journal reference is J9. Its account number is accounts payable is $1,200 of debit. So now it's a debit of 1200. Okay. So previously, okay. My bad, guys. Looks like we recorded this amount incorrectly. This amount should have been 1800. Please fix that. We recorded the account number instead of the dollar amount. Okay, now we have $1,200 of accounts payable being debited, and we will still have a credit balance of 600 because we had a credit balance of 1800. 1200 is debited out of that. So now our balance would be equal to 1800 minus 1200. Okay. So we can go back here, and accounts payable account number is 2100. And then the cash has to be recorded. So we go to the cash, and there is a $1,200 for that. So May the 17th, J9, and now it's a credit of $1,200. We still have a debit balance. The amount is equal to what we had minus the 1200. So we're left with $31,500. So we go to our journal and we write down the cash has been posted. The cash transaction has been posted. Okay, then we have May 19th, accounts receivable for 69,000 is a debit, and consulting revenue is 69,000 credit. So we have to post these into the ledgers. So accounts receivable, and the date is May 19th. Okay, coming from journal page 9, it's a debit for 69,000. So the balance will be debit, and 69,000. Okay, the other entry is accounts receivable, and the other entry credit is the revenue. So where is the revenue account? Consulting revenue. So May 19th, credit for 69,000. So we now have a credit balance of 69,000 in consulting revenue. Okay, go back to the journal and put down the accounts receivable account number, which is 1300. Consulting revenue account number is 4100. So those are posted. Okay, now we are left with May 30th. So for May 30th, we have the withdrawals debit of 8,000 and cash credit of 8,000. Okay, so we go and record the withdrawals. Here we go. So May 30th, from page number journal 9, page 9, and withdrawal amount is 8,000. So now there will be a debit balance for 8,000, and that has been taken from the cash. So the cash account will be credited for that amount, for the amount of 8,000. Again, the balance will still be debit because we still have a running balance, which is debit balance. So the normal balance. So here it will be 31,500 minus 8,000. So now we're left with 23,500 in cash. So we've recorded the withdrawal and the cash. So the withdrawal account was 3,200 and the cash account was 1,100. So now we have posted all these entries into the journal. Okay.